Have you ever stared at your bank statement wondering where all your money disappeared to? You know that sinking feeling when you realize you earned a solid paycheck this month, lived reasonably, yet your savings account looks emptier than a movie theater on a Tuesday afternoon. Meanwhile, everyone around you seems to have figured out some secret money formula. Your friend just booked another weekend getaway. Your colleague bought yet another gadget they probably don't need. And you're sitting there questioning whether you're the only person who apparently missed the memo on how to handle money properly. Well, here's something that might surprise you. Most people aren't actually better at managing money than you are. They're just making different financial mistakes. And some of these mistakes have become so normalized, so embedded in our culture, that we don't even recognize them as wealth destroyers anymore. We think we're being smart shoppers, responsible adults, or savvy consumers when we're actually feeding money into systems designed to keep us broke. Today's economic landscape has shifted dramatically over the past decade, but our spending behaviors haven't kept pace with these changes. Things that made perfect financial sense 5 or 10 years ago now represent terrible value. Strategies that once built wealth now actively destroy it. Products that provided genuine benefits have morphed into elaborate schemes designed to separate you from your hard-earned cash. Yet most people keep buying these things out of habit, social pressure, or because marketing teams have convinced them these purchases still make sense. Before we get into them, if you're new here, I'm Tim. I make videos to help you actually understand money so you can stop feeling behind and start feeling in control. If that sounds helpful, take a second to subscribe and turn on notifications so you don't miss what's coming next, especially if you recognize yourself in any of these habits. What I'm about to share with you represents thousands of dollars in annual savings for the average person. These aren't extreme lifestyle changes or monk-like sacrifices. These are common expenses that no longer provide adequate value for what they cost. When you add up all the money people waste on these items, we're talking about enough cash to completely transform someone's financial trajectory within just a few years. But here's what makes this even more powerful. The people who recognize these financial traps early don't just save money. They build wealth while everyone else spins their wheels wondering where their money went. They're the ones who mysteriously have cash available when great opportunities arise. They can take calculated risks that others can't afford. They retire earlier and live more comfortably during their golden years. The difference isn't necessarily that they earn more income. It's that they stopped throwing money away on things that don't work anymore. Before we dive into the specific items, let me give you a framework for understanding this. Every dollar that leaves your bank account falls into one of 3 categories. First, there are dollars that generate more dollars. These include investments, education that increases your earning potential, or business expenses that grow your income. Second, there are dollars that provide genuine value or necessity. Food, shelter, healthcare, and tools you actually use fall into this category. Third, there are dollars that simply vanish into thin air, providing neither financial return nor meaningful value to your life. Most people lose the money game in that third category without even realizing they're playing. The items we're going to discuss have quietly shifted from Category 2 to Category 3, often without people noticing the change. They used to provide real value. They used to make financial sense. But economic conditions, technological advances, market changes, and evolving business models have turned them into wealth destroyers. The problem is that old habits die hard, and marketing messages haven't updated to reflect these new realities. Let's start with something that sounds incredibly responsible and intelligent, but has become a wealth destroyer for millions of people: investments you don't understand. Now, before you roll your eyes thinking this is obvious, consider how many people are currently losing serious money on investments they couldn't explain to a 10-year-old. We're not talking about pocket change here. We're talking about people wiping out years of careful saving in just a few months. The cryptocurrency boom created millions of amateur investors who threw money at digital assets they couldn't define if their financial future depended on it. Startup investing platforms made it easy for regular people to fund businesses in industries they knew nothing about. Social media turned the stock market into a casino where people placed bets, based on online hype rather than financial fundamentals. The psychological trap is incredibly powerful. When an investment performs well, you feel like a financial genius. When it tanks, you convince yourself it's just a temporary setback while your money evaporates. Here's what's really happening. One bad investment decision can erase years of disciplined saving. I've seen people lose tens of thousands of dollars chasing investments they heard about from friends, saw promoted on social media, or read about in newsletters. They didn't understand the risks, the business model, the market dynamics, or the exit strategy. They just knew that someone somewhere was making money and they wanted in on the action. Knowledge isn't just power when it comes to investing. Knowledge is protection. Every dollar you invest in something you don't understand is a dollar. You're gambling, not investing. And in gambling, the house always wins eventually. The solution isn't to avoid investing altogether. It's to only invest in things you genuinely understand after doing proper research. If you can't explain how an investment makes money to a friend over coffee, you shouldn't put money into it. Moving on to something that affects almost everyone but flies completely under the radar: overpriced car insurance. This one is particularly painful because it's so unnecessary and so easy to fix, yet millions of people continue paying inflated premiums year after year. Most people are overpaying for car insurance by anywhere from $50 to over $1,000 annually. That's not an exaggeration. We're talking about enough money to fund a vacation, make extra mortgage payments, or significantly boost retirement contributions. The reason people overpay isn't because they need premium coverage or drive luxury vehicles. It's because they haven't compared rates in years, if ever. Insurance companies count on customer inertia. They understand that most people will automatically renew their policies without shopping around. So they gradually increase premiums, banking on the fact that you won't notice small increases or won't bother switching companies. Meanwhile, competitive companies are offering better rates to attract new customers, but you'll never see those rates unless you actively look for them. The process of comparing insurance rates takes maybe 30 minutes online, 30 minutes to potentially save hundreds or even thousands of dollars per year. That's better than most people's hourly wage at their day job. Yet they won't invest the time because it seems like a hassle. Meanwhile, they'll spend hours researching which restaurant to try or which movie to watch, decisions that cost maybe $50 and affect one evening of their life. The money you save on car insurance isn't just a one-time benefit. It's money that compounds year after year. If you save $500 annually on insurance and invest that money instead, you're looking at serious wealth accumulation over decades. This is the kind of consistent, boring financial optimization that quietly creates financial independence. Let's talk about something that used to be a great way to save money on travel but has become a complete scam for most people: short-term vacation rentals. The platform started as a way to find affordable, unique accommodations that were often cheaper and more interesting than hotels. That value proposition has been completely destroyed by hidden fees, inflated pricing, and policies that heavily favor property owners over guests. Here's how the numbers actually work out now. You see a listing for what appears to be a reasonable nightly rate, let's say $150. Then you reach the checkout page and discover there's a cleaning fee of $75, a service fee of $30, and various other charges that weren't immediately obvious. Your $150 room just became $255, and that's before local taxes. Compare that to a hotel room at $200 per night with no hidden fees, daily housekeeping, a front desk for problems, loyalty program benefits, and the ability to cancel without penalty if plans change. The vacation rental isn't just more expensive after fees, it's also less convenient and more risky. The platform has essentially become a way for property owners to run unlicensed hotels while charging premium prices and providing substandard service. The cleaning fees alone are often ridiculous. You're paying $75 for cleaning, but you're also required to wash dishes, take out trash, and strip beds before leaving. So you're paying premium prices for the privilege of doing housekeeping work yourself. Hotels provide daily cleaning as part of their standard service, yet somehow we've been convinced that doing the work ourselves while paying more money represents a good deal. The psychology behind extended warranties is both fascinating and depressing. You're standing at the checkout counter about to purchase a $500 appliance when suddenly the salesperson becomes your new best friend. They're deeply concerned about your future happiness and want to protect you from the devastating financial blow of potential repairs. For just $99, you can have complete peace of mind. What they don't mention is that extended warranties are pure profit centers with claim rejection rates that would make a dating app jealous. Extended warranties typically cost between 15 and 25% of the item's price, but the actual claim rate is usually under 15%. That means for every $100 consumers spend on extended warranties, only a small portion goes toward actual repairs. The rest becomes pure profit for the retailer and warranty company. Most extended warranties don't even activate until after the manufacturer's warranty expires, and they're loaded with exclusions that make them almost worthless when you actually need them. Water damage isn't covered. Normal wear and tear isn't covered. If you move the appliance, that might void the warranty. If you didn't register within 30 days using a process that requires multiple forms of identification, it's void. The real tragedy is that most people never even try to use their extended warranties when something breaks. They either forget they have coverage, can't locate the paperwork, or discover that the repair process is so complicated and time-consuming that it's easier to just buy a replacement. Meanwhile, that $99 you spent on warranty protection could have been invested and earning returns for years. If you're buying extended warranties on multiple items annually, you're easily wasting hundreds to over $1,000 on protection you'll probably never use and probably wouldn't work if you tried. That money could fund an actual emergency fund that protects you from unexpected expenses rather than funding an insurance policy designed primarily to generate retailer profits. Let's move on to something that sounds incredibly smart and responsible, but often becomes an expensive lesson in food waste: buying food in bulk when half of it ends up spoiling. The wholesale club membership seemed like such a brilliant idea. You're going to save money by purchasing larger quantities at better per unit prices. You're being a savvy consumer, thinking ahead, planning for the future. Then reality hits and your refrigerator transforms into a science experiment. The average American household throws away approximately 20% of the food they purchase. 20%. That's like taking every fifth grocery dollar and setting it on fire. For a family spending $400 monthly on groceries, that's $80 worth of food going straight into the garbage. Over a year, that's nearly $1,000 of waste, and that's just the average. Some families waste significantly more. Bulk buying amplifies this problem exponentially. You purchase the giant container of strawberries because the per-pound price is better, but strawberries last about as long as a TikTok trend before they start looking like a biology experiment. You stock up on fresh vegetables with the best intentions, but life gets busy, you order takeout a few times, and suddenly you're composting $50 worth of produce that you never had a chance to use. The psychology is predictable and costly. When you buy large quantities, you feel less guilty about waste because each individual item seems inexpensive. Throwing away one apple from a 3-pound bag doesn't feel as painful as discarding a single apple that cost $2. But mathematics doesn't care about your psychological rationalization. Wasted food represents wasted money regardless of how you justify it to yourself. Even worse, bulk buying often leads to overconsumption of items that don't spoil, like processed snacks and frozen foods. You buy the economy-size bag of chips because it offers better value, then consume twice as much as you normally would because it's readily available. You're saving money per unit while spending more money overall and potentially compromising your health in the process. Something that gets almost everyone because the marketing psychology is so sophisticated. Buying sale items you don't actually need. The clearance section is like a black hole for common sense and disposable income. You see something marked down 50%, and suddenly your brain starts performing mental gymnastics to justify why you absolutely need this item you'd never heard of 5 minutes earlier. Retail psychology has masterfully turned saving money into spending money, and most people don't even realize it's happening. You walk into a store looking for one specific item, but there's a promotion on something completely different. The original price was $70, but today only it's $35. You're saving $35, except you're not saving $35. You're spending $35 on something you didn't want or need until a price tag convinced you it was a bargain. The average person spends hundreds of dollars annually on sale items they never use. Clothes that hang in closets with tags still attached. Kitchen gadgets that occupy drawer space but never encounter actual food. Books that seemed interesting at clearance prices but never get opened. Electronics that appeared to be good deals until you realized you already owned something that performed the same function. Every time you purchase something on sale that you don't use, you're not just wasting the money you spent. You're also giving up the opportunity to invest that money or spend it on something you genuinely value. That $35 clearance purchase could have been $35 toward paying off debt, building an emergency fund, or investing for retirement. The clearance mindset creates a scarcity mentality that overrides rational decision-making. You feel pressure to buy immediately because the sale won't last forever. Even though similar sales happen constantly, retailers rotate their clearance inventory specifically to create this sense of urgency and scarcity. There will always be another sale, another clearance event, another limited time offer designed to trigger your fear of missing out. Now let's talk about something that hits people right in the emotions and the wallet simultaneously: unnecessary holiday and birthday gifts. The average adult spends between $500 and $1,000 annually on gifts for people who probably don't need or particularly want what they're receiving. We've created this elaborate system of obligatory gift exchange that enriches retailers while stressing out consumers and cluttering everyone's homes with items they don't use. Think about the last 10 gifts you received that weren't from immediate family members. How many of those items do you still use regularly? How many brought genuine value to your life? How many are sitting in a closet, drawer, or garage, serving no purpose other than generating guilt when you consider donating them? The gift-giving industrial complex has convinced us that love and friendship are measured in dollars spent at retail establishments. Here's what's really happening in this system. You spend $50 on a gift for your colleague's birthday celebration. They spend $50 on something for you when your birthday arrives. You both end up with items you don't particularly want, paid for with money you both could have used for something meaningful. It's like a complicated money laundering scheme where everyone loses except the retailers. The worst part is that gift giving has become this strange financial hostage situation where nobody wants to be the first person to suggest maybe we should all stop buying each other stuff we don't need. Meanwhile, everyone secretly hopes someone else will suggest it first. It's like a standoff, but instead of weapons, everyone's holding credit cards they can't afford to use. The solution isn't to become a holiday Grinch or skip every birthday celebration. It's to have honest conversations about simplifying gift exchanges or focusing on experiences rather than objects. Some families have started doing gift exchanges with spending limits instead of buying presents for everyone. Others have agreed to skip gift exchanges entirely for adults. A few groups have instituted homemade gift-only policies or agreed to donate to charity instead of exchanging presents. Let's shift gears to something that's destroying entire generations financially: paying for degrees you don't use. The higher education industrial complex has convinced millions of people that any degree is better than no degree, regardless of the financial mathematics involved. Meanwhile, graduates are walking across stages with pieces of paper that cost more than luxury vehicles and qualify them for jobs that pay less than skilled trades. Here's the brutal reality check that nobody wants to discuss. If you borrowed $40,000 to get a degree in a field where the average starting salary is $35,000, you didn't get an education. You got financially scammed. The debt payments on that education loan will follow you for decades, preventing you from buying a home, starting a business, or building wealth during your prime earning years. The psychology behind this is understandable but devastating. Society has spent decades telling young people that college represents the only path to middle-class prosperity. Parents want their children to have opportunities they didn't have access to. Students believe they're investing in their future earning potential. But when the mathematics doesn't work out, good intentions become financial disasters that take decades to recover from. The irony of student loans is particularly cruel. You're told education represents an investment in yourself, but investments are supposed to generate positive returns. If your education generates negative returns for the first 15 years of your career, that's not an investment. That's an expensive mistake with a graduation ceremony attached to it. This doesn't mean education is worthless or that college never makes sense. It means being strategic about what you study, where you study it, and how much you're willing to pay for the experience. Community college transfers, in-state tuition rates, scholarships, And choosing fields with actual job prospects can make education a genuine investment rather than a financial death sentence. But borrowing 6 figures to study something with limited earning potential is like buying a Ferrari to deliver pizzas. Moving on to something that seems insignificant but adds up to shocking amounts over time, small daily spending habits that provide zero lasting value. That $6 coffee every morning, the $12 lunch you grab because you didn't meal prep the night before, the random snacks, energy drinks, and convenience store purchases that happen without conscious thought throughout your day. Here's where the mathematics gets depressing. A $10 daily habit costs you $3,650 annually. Most people have multiple $10 habits: the morning coffee run, the afternoon snack attack, the evening convenience store stop for whatever caught their attention. We're talking about enough money to fund a substantial vacation, make significant debt payments, or build impressive emergency savings. It's not just about the immediate cost of these purchases, it's about the opportunity cost of that money over time. $10 invested daily at reasonable returns becomes enormous wealth over decades. Instead, it's buying temporary satisfaction that's forgotten within hours. You're trading long-term financial security for short-term convenience and momentary pleasure. The psychological trap is that each individual purchase feels insignificant. $6 for coffee doesn't seem like a big deal when you're earning decent money, but $6 multiplied by working days, multiplied by years, becomes a substantial sum that could have changed your financial trajectory if deployed differently toward wealth-building activities. Now we need to talk about a much heavier version of this same problem: drugs, alcohol, and gambling. These aren't just small habits. They're escape valves that can quietly vaporize your wealth and your health at the same time. A couple of drinks after work to take the edge off turns into a few $100s a month. Weekend gambling that doesn't really count because you're using cash turns into thousands per year, disappearing with nothing to show for it. Recreational drugs that started as just for fun become a recurring line item in your budget, and a very expensive one. The danger with drugs, alcohol, and gambling is that they create negative compounding. The more stressed you are about money, the more tempting it is to use them as an escape. The more you use them, the worse your finances get. And the worse your finances get, the more stressed you feel. It's a loop that quietly destroys both net worth and mental health. Beyond the direct cost, there's the hidden bill: missed work, poor decisions made under the influence, damaged relationships, health problems that show up years later. You can't build a stable financial future on top of habits that consistently pull money, focus, and self-control away from you. I'm not here to tell you what you can and can't do with your life. But if you're serious about building wealth, you have to be honest about whether you're using substances or gambling as entertainment or as anesthesia. One of the highest ROI decisions many people will ever make is simply cutting these habits down drastically, or cutting them out altogether and redirecting that money into investments, debt payoff, or an emergency fund. Finally, let's talk about the big one, the expense that kills more financial dreams than any other: overpaying for housing. Whether you're renting or buying, housing typically represents the largest expense in most people's budgets. Because it's so large, even small mistakes in this category have massive financial consequences that compound over years. The traditional advice suggests that housing should cost no more than 30% of your gross income. But in many markets, people are spending 40, 50, even 60% of their income on housing costs. This leaves virtually nothing for saving, investing, or building wealth. You become enslaved to your mortgage or rent payment, working primarily to keep a roof over your head, while every other financial goal becomes secondary. Here's what happens when you overpay for housing. You can't build an emergency fund because all your money goes to housing costs. You can't invest for retirement because you're house poor. You can't take career risks or start a business because you need every paycheck to cover your oversized housing payment. You become trapped in a golden cage of your own making, working to service debt rather than building wealth. The solution requires uncomfortable honesty about your actual needs versus your wants. Do you need the prestigious neighborhood, or do you simply want it? Do you need the extra bedroom that will sit empty most of the time? Or would a smaller space allow you to build wealth? Do you need to buy immediately, or could you rent affordably while saving for a larger down payment that would reduce your monthly obligations? Housing decisions made in your 20s and 30s determine your financial flexibility for decades. Every extra dollar you spend on housing is a dollar you can't invest, save, or use to build wealth. This single category can make the difference between building substantial wealth and staying broke despite earning good money. Choose carefully because these decisions compound over time in ways that either build or destroy your financial future. There you have it. 10 things that are no longer worth buying, representing thousands of dollars in potential savings annually for most people. The beautiful thing about avoiding these financial traps is that the money doesn't just disappear into thin air. It can be redirected toward things that actually build wealth and improve your life meaningfully. When you stop throwing money at investments you don't understand, you can focus on building wealth through simple, proven strategies. When you stop overpaying for insurance, that money can go toward emergency savings or retirement contributions. When you choose hotels over overpriced vacation rentals, you save money while getting better service. When you skip extended warranties, you can build a real emergency fund that actually protects you. When you buy only the food you'll actually consume, you stop funding grocery store profits with your waste. When you resist sale items you don't need, you can spend money on things you genuinely value. When you simplify gift-giving traditions, you reduce financial stress while focusing on meaningful relationships. When you choose education strategically, you invest in skills that actually increase your earning potential. When you eliminate unnecessary daily spending, and especially when you cut back on drugs, alcohol, and gambling, you free up thousands of dollars annually for wealth building. And when you right-size your housing costs, you create space in your budget for every other financial goal that matters to you. The people who recognize these traps early don't just save money. They redirect that money toward investments, emergency funds, debt payoff, and experiences that actually enhance their lives. They build wealth while everyone else wonders where their money went. They have options when opportunities arise because they stopped funding industries built on financial ignorance. Start with 1 or 2 areas where you're currently throwing money away. Calculate how much you could save annually by making smarter choices. Then redirect that money towards something that actually moves you closer to your financial goals. Small changes in spending habits compound into massive differences in wealth accumulation over time. Your future self will thank you for every dollar you stop wasting today. Stop funding these systems designed to keep you broke and start building the financial life you actually want instead. And if you want more videos that break money down in plain English, remember to subscribe before you click away, so the next time everyone else is wondering where their money went, you'll actually have an answer.